Live from New York City this morning. Good morning, good morning. Let's get your week started. Equity futures just about unchanged on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, the president returning from Japan to problems at home. As Yellen doubts the U.S. can pay its bills beyond mid-June, Fed Chair Jerome Powell tees up a break from hiking rates. We begin with the big issue. Talks between the president and Speaker McCarthy resume. Kevin McCarthy says time is of the essence.
He's now bringing something to the table that everyone said was off the table. It seems as though he wants default more than he wants a deal. That's not where I'm at. I will never give up.
President Biden throwing the ball back in his court.
Now it's time for the other side to move from their extreme positions, because much of what they've already proposed is simply, quite frankly, unacceptable.
With tensions growing, time is running out. As of late last week, the Treasury's cash balance stood at just over $57 billion, down from $140 the week before. Treasury Secretary Janet Yellen says the U.S. is unlikely to be able to pay its bills by the middle of June.
Well, there's always uncertainty about tax receipts and spending. And so it's hard to be absolutely certain about this. But my assessment is that the odds of reaching June 15th while being able to pay all of our bills is quite low.
Economists at Goldman Sachs agree. The early June X date may well be real. They say this: there is certainly a chance the receipts could slow more than expected and leave the Treasury short of cash by early next month. Team coverage starts right now with Anne-Marie joining us from Tokyo, Kelly Lydes down in Washington, D.C. AMH, first to you. The G7, you and I talked about this. Did we even get a G7 this weekend?
We did. We certainly did get a G7, Jonathan, especially when you look into some of the intricacies and the language regarding China and President Zelensky here. There was a lot of emphasis on Russia, but obviously what loomed very large, the very big elephant, if you will, in the room for President Biden as he sits across from other world leaders, of course, was whether or not the United States would, in fact, default or not. This is something that, whether it was the G7 finance ministers meeting in Niigata, where I sat down with Secretary Yellen, or if it was the leaders' ministerial meeting in Hiroshima, the debt ceiling is what everyone was concerned about, because they are worried about the economic risk that may be emanating from Washington. And Jonathan, of course, this was one of the biggest talking points because President Biden had to cut his trip short. This is a strategic foreign policy goal for this administration to make sure that they are active in the Indo-Pacific, and they had to cut their trip short, not going to Papua New Guinea and not going to Australia. And instead, the president went home last night, and the person he called on Air Force One was Speaker McCarthy.
And Kelly, those talks resume again this morning, throughout this afternoon. Kelly, what are you focused on through today and through this week?
Well, frankly, it's going to be whether or not a deal can be completed and get to the floor of the House this week, John, because remember, it's May 22nd. We are now 10 days away from June 1st and theoretically the earliest potential date that the U.S. defaults. So time is very short here as we prepare for the president and the speaker to meet in person today after their phone call yesterday, which Anne-Marie mentioned. And of course, their aides, those focusing on these negotiations for the two parties, did meet for 2 hours last night. But we understand really the points of contention here are now around the idea of spending cuts and spending caps. Republicans previously had wanted 10 years worth of spending caps. We understand, based on our reporting here at Bloomberg, that has now come down to 6. The administration, though, wants those spending caps to last just 2 years. There's also the idea of where spending should be cut or not. Republicans would like to see more defense spending, which would mean more cut to social programs. That is a difficult proposition for Democrats. The idea of work requirements for entitlements as well has become a sticking point, because now in these talks, the formulation of a deal has to consider whether or not it could get enough support from both chambers of Congress, because there are issues that Democrats have, work requirements and spending being one of them, and Republicans have other red lines as well. And that makes it difficult to see how the caucuses could come together and actually get this thing passed, assuming a compromise can be made in the coming days, John.
We've had a weekend full of mood music headlines, Anne-Marie. We discussed that earlier once again. We're all sick to death of it. Just follow the money. The cash balance of the Treasury is just going down, 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 down. As a practical matter, AMH, how much time is left?
Well, if you take Treasury Secretary Janet Yellen for her word, what she's assuming and trying to work on is the fact that she's considering June 1st a hard deadline. And what she said in that, she doesn't think they're going to have in that interview with NBC News over the weekend, is she doesn't think that the Treasury will have enough money to make it to June 15th, potentially when they have another realm of tax receipts coming through. And Jonathan, that is precisely why you see this momentum of Speaker McCarthy and President Biden getting in a room together today. And before they get in a room, in about 10 minutes time, the White House negotiators will also be at the Capitol. So you're going to have another round of talks between the GOP and Biden's negotiating team before Speaker McCarthy and Biden sit down. So it does seem like they are trying to move on this. Why? Because they are concerned about this June 1st deadline. It's why the president had to cut short a very important trip to Papua New Guinea and Australia as they try to talk tough on China, because he wanted to make sure he was home so that they didn't default.
We're going to talk about China in about 40 minutes' time. Stay close, guys. AMH, Kelly Lyons on the latest on the debt ceiling negotiations down in Washington. Joining us now to discuss, Aberdeen's James Athey, Columbia Threadneedle's Gene Tenuzzo. Gene, first question to you, sir. The House Speaker says time is running out. How much time do you think is left?
Well, I will take Treasury Secretary Yellen at her word that next week is a hard date. There's probably a little cushion baked into her forecasts in order to, give the administration a little bit more time. But the fact of the matter is, John, if you look at the Treasury bill market right now, there's not a lot of stress baked in specifically around the debt ceiling. So I have a hard time believing that even if we get a bill passed this week, let's say, that we see a huge sigh of relief in the bond market.
James, do you think we need to get closer to an accident before we get closer to a deal?
Yeah, generally that's been the case, isn't it, John? Unfortunately, we're dealing with a lot of ideology here and not necessarily a lot of economics. There are seemingly some fairly hard red lines, which, again, just come from the underlying beliefs of the actors and the parties involved and don't really bear any resemblance to the on-the-ground economic reality that we see in front of us, and that's always a very tricky situation. I would have thought the fact that equity markets seem to be carrying on regardless does just lift a little bit of external pressure, and maybe we need to see that situation change to force a deal over the line.
I think we've all seen a ton of scenario analysis. UBS puts some out. What would happen? What if? This long list of what ifs. Worst case scenario outlined by the bank would be marked by a prolonged 1-month delay in all US payments. They said it would lower GDP by an additional just 0.8 percentage points, 700,000 job losses, cause a 30% immediate drop in stocks. Of course, they suggest, Gene, that this scenario is, quote, very unlikely. Gene, a lot of people watching this conversation, listening to Kayleigh, listening to Anne-Marie, listening to you, listening to James, they just sit there and say, this is pointless, it's a waste of time, they're going to come to a deal and we'll all move on. Gene, do you consider this all a waste of time?
Well, look, John, Congress has raised the federal debt ceiling 78 times since 1960. So building an investment strategy that the 79th time is the charm is a very difficult thing to recommend. I agree the political dynamics are different this time, but no party has an incentive to get a deal done any earlier than the deadline, the 11th hour, but both parties have an incentive to get a deal done. So we do think it's going to happen, but you have to plan for the worst case just in case.
Well, what's the base case, James? Not the base case, not the worst case, the base case. Less spending, weaker growth. Is that the outlook, James? Is that your base case now?
Yeah, I mean, I completely agree with Gene. You can't really think that this time is necessarily different because this situation has been going on for years and years and decades and decades. Indeed, if we look back at 2011, actually a lot of the damage in markets was done after the deal was done because almost by definition, not quite, but almost by definition, you need to see something given to the Republicans to get them on board. And of course, that's likely to take the form of spending cuts, and that's a growth headwind, which I don't think is at all baked into markets at the moment. So I think we get a deal. I don't think anybody is delighted about it, but everybody's somewhat satisfied. But I do think there is still downside risk to equities and bond yields from the fact that it's likely to be impeding growth going forward.
Well, perhaps oddly then, Gene, are you in the same boat? Is this the kind of situation that makes you more comfortable, not less comfortable, more comfortable owning treasuries?
I think longer term treasuries, yes, John. We do believe that. I think growth has continued to slow. If you look the last 5 quarters, basically since the end of 2021, growth in the U.S. has been less than 1% on a real basis annualized. So that sort of run rate of growth is quite low. And if we were to see a shock to the extent that James described, I think that could be enough to bring us into mild recession. So I think, from that standpoint, longer-term Treasury yields have room to go lower simply from a growth standpoint, not to mention the potential flight to quality that could come from a debt ceiling. I still think on the shorter-term side, as we continue to digest comments from the Fed, including Bullard this morning, and as we get closer to that June FOMC, I think that 2-year yield still has room to rise. So I think this inverted curve can get more inverted from here.
Well, that's a call. Right now, yields higher at the front end by 3 basis points, just short of 430 on a 2-year. Jim Bullard of the St. Louis Fed, if you are just tuning in, said he's thinking 2 more rate hikes this year. We'll wrap up the Fed speak in just a moment. James Athey, Gene Tenuto sticking with us, looking at the equity market going into the opening bell. About 20 minutes away. Equity futures pretty flat here. Let's get you some movers. Here's Abby.
Beneath the surface, John, there are a number of movers, especially to the upside, which we'll start off with, and then to the downside. To the upside, we do have regional banks popping. PacWest higher on the announcement that they're going to sell $2.6 billion in real estate loans related to construction to Kennedy Wilson. That stock soaring. Investors really sighing some relief there. KeyCorp raised to buy at Odeon Capital. They've also set a price target of $11, also higher, up 2.2%. To the downside, though, Micron down 3.6%, well off of its down 6% lows, as China says that some of their products were found to be a cybersecurity threat after a review. Beijing warning operators against buying the company's goods. And then finally, Meta down 0.7%. They've been fined a record $1.3 billion in the EU over U.S. data transfers, warning the company to stop transferring users' data to the U.S. For a company that is scheduled to make $127 billion this year, though, John, it seems at $1.3 billion, it's not so much. The stock down mildly.
Abby, thank you after a massive run year to date. Coming up, Chair Powell seemingly prepared to skip June.
Having come this far, we can afford to look at the data and the evolving outlook and make careful assessments.
That conversation up next.
We've come a long way in policy tightening, and the stance of policy is restrictive. And we face uncertainty about the lagged effects of our tightening so far and about the extent of credit tightening from recent banking stresses. Having come this far, we can afford to look at the data and the evolving outlook and make careful assessments.
This is never a good ingredient for a good panel when your panelist is sitting there just reading prepared remarks. That was Chairman Powell reading carefully from those pre-prepared remarks, teeing up a break from hiking interest rates. One hawkish member of the Federal Reserve open to the idea. Minneapolis Fed President Neil Kashkari telling the Journal, if the committee chooses to skip a meeting because we want to get more information, I could make the argument why that makes sense. A skip to get more information is very different in my mind than saying, hey, we think we're done. Jim Bullard of the St. Louis Fed indicating he certainly isn't done. Quote, we're going to have to grind higher. I'm thinking 2 more moves this year. Mike McKee joined us to wrap it up. Morning, Mike.
Good morning, John. Well, what happens when the Fed chairman speaks and nobody listens? Take a look at where we are in terms of the market's view of where we'll be in January 2024. They had been forecasting at least 3 cuts, and now we're moving higher. It looks like Jay Powell on Friday had a very small effect, but it did not last very long. And so at this point, we're looking at Powell's compatriots to see where they are. And as you mentioned, Neil Kashkari getting some traction in the headlines on this we could skip thing. But basically, he moved ahead and said to the Journal and also on CNBC today that we may need to get to 6%. And it's important to me that we're not signaling that we're done. And as you mentioned, Jim Bullard saying we're going to have to grind higher. I'm thinking 2 more moves this year. So we're seeing a majority of those who've spoken out so far suggesting that there is a lot more work to do, that inflation's not coming down as fast as they hope. So we may get into this skip versus pause idea. as you could see there on the calendar. We do have some more Fed speak after Bullard today. I'd look to Mary Daly. She hasn't said a whole lot so far. And also Chris Waller on Wednesday, along with the Fed minutes. Those two things should give us some real clues. Waller's been relatively hawkish, and he has a vote. So which way is he going to go? And the Fed minutes, what did they talk about at the last meeting in terms of the idea of a pause?
And Mike, do you think the bar is higher right now to skip June or to hike in June?
Well, I think it's about 50-50 right now because we don't have all the data. Friday, you saw on the calendar as well, we do have the PCE inflation numbers. That could influence the Fed. We'll see if they come down at all, especially in the core. And, of course, they get the jobs report next week, and we get the inflation report, CPI, just before the Fed meeting. So most of them wait and see until the last minute whether there's any progress that's been made.
Mike McKee, thank you, buddy, as always. Gene Tenuzzo, James Athey, back with us. Now, Gene, the St. Louis Fed President Jim Bullard says he isn't done. He indicates maybe 2 more hikes this year. Do you still think this Fed is done?
I do think they're done. I think it's important that we got confirmation, or at least some confidence in that, from Powell on Friday. And I think it's important that Kashkari, who is on the hawkish side of the committee, is seeming open to pausing as well. I think what the Fed wants, and the reason we're hearing all of this language from Bullard and several speakers last week, is that they want optionality. They don't want to be boxed into a corner that they have to be on hold and that they perhaps have to cut later in the year. I think at the end of the day, if you have to put your chips somewhere, I'd put them on the Fed this year, being able to hold the line and hold rates. And then I'd put them on the market next year in terms of being more likely to bring rates down, maybe even in a meaningful way.
James, how important is the difference between a pause and a skip?
I'm not a massive fan of these linguistic acrobatics that central banks end up getting themselves into. But, you know me, John, I'm generally pretty critical of central banks. I think the Fed's done the best job out of the majors in the last, since their dovish mistake. I think the communication from Jay Powell and Neil Kashkari there, that's pretty much spot on, really, given where we are. They both recognize that a lot of work has been done, that obviously today's data is telling us something about yesterday, not about tomorrow. And of course, there is still a lagged effect from prior tightening, which is latent, which is not really yet acting on the economy. And so taking a pause just to buy themselves another month's worth of data, it's not like inflation has started going back up again. Though, of course, the jobs market has been stronger than expected. If they can get a bit more data, get a little bit more clarity on the direction of travel for the labour market and the extent of core disinflation, I think they would feel more comfortable making a decision to hike at that stage. But my base case, like Gene, is that they're probably done here. I think we're going to see some of this data rolling over a bit more significantly in the coming months.
So, Gene, tell me, if you think they're done, why do you think yields keep pushing higher at the front end? 7 consecutive days of this now, up another 3 basis points on a 2-year, close to 430. Gene, you mentioned briefly that you think maybe there's a little bit more space there and that this curve inversion has got a way to go. Why?
I think that's the battle the Fed's going to continue to fight through the rest of this year. Remember, the Fed funds rate already is 5 to 5.25. So the 2-year yield is somewhere around 100 basis points below that almost. And the Fed wants the market to believe that they could stay put for a while, and they want to push that 2-year yield closer to where the Fed funds rate is. And in history, in other cycles, we have seen them be successful at that. So I think they would view that as having more optionality. Ultimately, I think they'll be able to do that for a while, but I think in the end, they will be at a point where they'll have to ease probably next year, and that's when we'll see really yields come down in a more meaningful way.
Gene, is inflation going to allow them to do that?
I think it will. In fact, base effects are going to be very helpful starting in a month or two here. We're going to get likely CPI with a 3 handle instead of a 5 handle. Now, that's not quite at their target, but it's making significant progress. And in the second half of the year, we should get a lot of help from the owner's equivalent rent side of things because the lagged effects of housing. So I think, yes, I think ultimately inflation will move from being a headwind to being a tailwind for their mandate.
Well, let's talk about what that means for the longer end of the curve. You mentioned a 2-year. Maybe there's some space to move higher. 430 right now on the screen. 10-year at the moment, just south of 370. Gene, what kind of levels are you thinking about at the long end? What are we coming down to?
Well, it's hard to pick a date and a number, but I think as we move forward, moving closer to a 3% level on the long end of the curve for like a 10-year treasury is much closer to fair value. And even if you take the Fed at face value in their summary of economic projections, their long-term forecast for the average short-term interest rate is 2.5. So I would view the gap between 2.5 and where long-term yields are today as a Fed credibility risk premium. And as we get closer to their 2% inflation target, that should narrow.
James, would you go with that?
Yeah, I think I agree with Gene's analysis there. Absolutely. I think that the bar to getting 10-year rate down to about 3%, a little bit on the high side, because at the moment we're still in an inflationary regime. And so there'll be some positive risk premium, term premium, inflation premium. But I do think the front end's interesting. The front end obviously reflects a probability distribution, looking at pricing and saying, hey, look, the market thinks the Fed's going to cut 50 this year. I don't think that's the right way to go about it. If you start scribbling down, probabilities of them doing another 25, another 50, them being on hold, or them even cutting, a little bit, cutting back to neutral or cutting a lot, you can quite easily get to the kind of downward slope that we've seen in recent weeks. And so I don't think that's as obviously a slam dunk to be short, depending on your subjective probabilities of the likely outcomes. And of course, that's a decent yield to own in the front end, pretty risk-free when risk assets look rich. So yeah, sure, there's time decay. If nothing really happens, you're going to lose a little bit of money as that 2-year rate just sort of rolls back up the curve. But I think you buy yourself a lot of optionality, because we've already seen that within the financial sector as well as within the economy, there are potentially some significant potholes ahead of us.
Yields a bit higher this morning at the front end. Gene Tenuto, James Athey, to the both of you, thank you. Federal Reserve speakers right now doing their best to suggest if it's a skip, it's certainly not a pause. And then you get people coming on this programme who just hear they're done. They're done. We'll see if they're done. Equity futures right now unchanged on the S&P 500. Coming up the morning calls and later, Bank of America boosting its equity outlook. Morgan Stanley sounding the alarm. We'll get the outlook from JP Morgan's Elise Ossenbaugh. That conversation still ahead. Your opening bell 7 minutes away. 5 minutes away from the opening bell this morning. Good morning to you. Equity futures just about unchanged on the S&P 500. That's the price action. Let's get you some morning calls. First up, UBS upgrading DraftKings to buy, expecting stronger revenue growth due to the company's rapid US expansion. Next up, Williams Trading downgrading Nike to sell, seeing a challenging US environment with a weakening product mix and cautious consumers. That stock is negative 1.5%. And finally, Loop Capital downgrading Apple to hold, saying macro headwinds are starting to weigh on demand for the company's iPhones. That stock slightly negative, down by 0.83%. Coming up, Morgan Stanley pushing back against the rally. We get the view from JP Morgan's Elise Ossenbaugh next at the opening bell. From New York City, your opening bell up next. 24 seconds away from the opening bell this morning. Good morning to you. Equity futures unchanged on the S&P 500. A week of gains last week, a decent week of gains, the biggest week of gains on the S&P going back to March. On the Nasdaq 100, 4 consecutive weeks of gains on the Nasdaq. Equities keep climbing higher. There's the opening bell. Switch of the board and get to the bond market. Yields climbing higher for a 7th consecutive session. Yields up again by a basis point or 2 on a 10-year, 369 on a 2-year, still climbing every single day last week and some. Up again this morning by 3 basis points. A very brief break of 4:30 as the St. Louis Fed's president, Mr. Bullard, speaks again and tees up from his perspective what he would like to see as a couple more hikes. In the FX market, the euro against the dollar, that currency pair negative for a second week last week and trying to bounce and not doing a good job of it. 108.10 on that currency pair at the moment, and crude totally unchanged. Call it a snooze, 71.55 on WTI. About 30 seconds into the session, equities just about unchanged on the S&P and on the Nasdaq. One stock to watch at the open, Micron. Shares under pressure after China announced its products failed to pass a cybersecurity review. The CEO of Micron saying, quote, "We're evaluating the conclusion and assessing our next steps." Abby has more. Hey, Abby.
Hey, John. So the stock is down about 3%. Its worst day since early April. At the lows, down more than 6%. Its worst day of the year. This as investors assess what this means. So at a headline level, it's clearly bad. bad. China is saying that these chips, both NAND and DRAM, that there's a cybersecurity threat, did not pass a review, so they're barred. But when you dig in a little bit deeper, you have to consider a few things. First, how much revenue is from China? It's about just mainland China, it's about 11%. If you add Hong Kong, it's about 16%. But it's a very specific barring, if you will. It's of their critical infrastructure operators. And if you look at the revenue from last year in terms of this piece, it was roughly 20% of its revenue from last fiscal year was from the enterprise and cloud server. So then if you times that by the mainland China, it's, it's maybe about 2% of revenue. So that's probably why the stock is off the low. But nonetheless, some analysts out there saying that it could also contribute to a problem for their gross margin recovery. And again, from a headline perspective, it's not great. And tensions between the U.S. and China around technology, not great. But for Micron, it wouldn't be surprising to see if this stock works off of these lows, John.
The stock is negative by almost 4%. Abby, thanks for that analysis. Just amazing to hear the president say relations between the U.S. and China would improve, quote, very shortly. And very shortly after that, this news dropped. That stock is negative by 3.5%. I can tell you, Katie Lyons in Washington, AMH over in Japan, joining us again in about 10 minutes to break this story down in greater detail. Want to pick up on Meta. Abby mentioned it a little bit earlier this morning. The company getting hit with a record $1.3 billion EU privacy fine over US data transfers. Meta responding in a statement, writing, quote, this decision is flawed, unjustified, and sets a dangerous precedent for the countless other companies transferring data between the EU and the United States. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, can you explain what's gone wrong here for Meta?
Well, so this is the third time they have to pay a fine in terms of how they store data, and the data transfer is something that was highlighted as part of GDPR. They should have complied by now. Clearly, that's not the case. And look, I think from my perspective, this just goes to show the risk they have, both in terms of combining the data across the apps and going across regions. And if regulators don't allow that, that hurts their ad targeting. So in this case, Meta gets about 23%, or based on our estimates, about $27 billion revenue from the EU region. IDFA, we know last year was a big drag on, in terms of the Apple changes and what it did to their revenue. This could be at least, $2 to $3 billion headwind just in terms of the ad targeting side if this was to, be more restrictive.
1.3 billion, not enough to hurt this name. It's had a massive move year to date, as you know, Mandeep. The stock is up again by 0.8%. Mandeep, work through this statement together with me. The decision is flawed. It's unjustified. It sets a dangerous precedent for the countless other companies transferring data between the EU and the United States. Are we suggesting here that other companies will get caught up in this?
Well, so think of it this way. Alphabet has been paying fines over the years. They've paid of the tune of, $8 to $10 billion in cumulative fines. And in this case, for Meta, this isn't going away. This is not the last fine that they have paid. And clearly, when we're talking about large language models, it's about getting more and more data together to train these models. Guess what? They can't even, marry the EU and the US data, even though it's from the same company. So clearly, this will be restrictive in terms of their product development and their ability to target ads.
The stock now up by 1%. Mandeep, thanks for the breakdown of what's gone wrong or what's going right with Meta right now, because what's going right is that stock is absolutely flying year to date. The financials have been struggling, as you know. They've been moving in the other direction, particularly the regionals. PacWest is higher this morning, though, by almost 7%, agreeing to sell a $2.6 billion portfolio of real estate construction loans amid efforts to shore up liquidity. Katie has more. Hey, Katie.
Hey, John. Well, yeah, so this portfolio in particular, it has 74 real estate construction loans. They're being sold to Kennedy Wilson Holdings at a steep discount. Of course, like you say, this move aimed to shore up liquidity. And it seems like investors are welcoming that move. You have PacWest shares rising this morning, of course, still down over 70% for the year. But also in the banking world, I want to talk about Greenhill a little bit, because shares absolutely soaring this morning following news that Mizuho will buy the investment bank in a deal valued at about $550 million. That is boosting Greenhill shares up over 100%. As you can see, some of the other regionals rising as well. We have KeyCorp on there, as is Zions. So really a bit of a lift to the sector, even though we know that there are still some big question marks out there.
Katie, thanks for that. The latest on the financials, the tie-up, Mizuho making some deals out there, PacWest offloading some stuff it wanted to offload. Here's the broader price action right now. About 6 minutes into the session, positive by 0.2% on the S&P. On the Nasdaq, higher again, even with this shift higher in yields. The 2-year right now up by another 3 basis points. Let's call it 430. The last time we had a session where the 2-year yield actually dropped was May 11th. On that day, we dropped by about a basis point to just sub 390. Let's call it 389. We've had a 40 basis point move since then, across 7 consecutive sessions. Yields keep pushing higher, and this equity market is coping with it and doing okay after finally breaking out above this year's tight trading range. I think one question remains now. It dominates. Are we breaking out? Morgan Stanley's Mike Wilson says the short answer is no. There are many technical signals that conflict with the idea that this is the beginning of a new cyclical bull market. Extreme narrowness, poor breadth, quality defensive leadership and broad cyclical underperformance. JP Morgan's Mislav Matejka says markets could face a lose-lose situation. Markets need to negotiate what is likely to be an increasingly challenging growth policy trade-off in the second half. The markets in the second half could be caught between a rock and a hard place. Luke Carr of UBS says stocks cannot go higher until DC officially avoids a default.
With equities and about near the top of a 7-month range, it's really difficult to see that now, before this being solved, being the proper time for a real, true, genuine breakout.
Joining us now to discuss is JP Morgan's Elise Ossenbach. Elise, wonderful to catch up with you once again. Do we have the potential here for a positive breakout in this equity market?
Over the near term, we think so. You think about the favorable earnings that came in well above expectations for the first quarter. You think about this debt ceiling overhang that arguably is probably putting a lid on the broad index. And so long as we get a resolution to the debt ceiling, which is our base case, we do think that it's possible in the near term you actually see the S&P 500 break above our year-end target of 4,300.
If equities do break out, Elise, above your price target, are you expecting leadership to change? Stuart Kaiser of Citi was writing about this yesterday. He said it's the #1 question he gets fielded from clients at the moment. Will we get a leadership change if we get a continued breakout?
Not necessarily. I think mega cap tech and other mega cap cohorts are being rewarded because they kind of went through that phase of retrenching and refocusing their businesses. And so investors are starting to gravitate there. But we would actually use those rallies into strength as opportunities to reposition, diversify some risks, especially understanding that a lot of the investors we work with remain well overweight those segments of the market. And we would favor diversifying into areas like Europe or even mid-cap domestic equities.
Let's build on that a little bit more. Savita Subramanian of Bank of America out this morning, raising her outlook over at B of A on the S&P 500. The year-end price target is going from 4K to 4,300. They prefer the equal-weighted S&P to the cap-weighted S&P. They like the cyclical story as well. Elise, does some of that resonate with you then?
Some of it, right? We see pockets of cyclicality that perhaps look attractive. Semiconductors, although they oftentimes get clumped in with that growth complex, to us tell a favorable cyclical story, especially after the experiences of 2022. But on the whole, in the near term, say for the duration of 2023, we are actually favoring the growth factor modestly over cyclicality, again, because of those dynamics that we saw in terms of those businesses adjusting to the environment that we're in and already taking those measures to cut costs.
At least there's a temptation for me to ask you whether you need the Fed to stop hiking or cut interest rates. But I look back at the year we've had and it's yields up, Nasdaq okay, yields down, Nasdaq okay. Elise, just how important is the rate story to the performance of some of these names?
Look, I think there's a lot of emphasis on the macro story, particularly as it relates to the Fed. Perhaps the market is a little over its skis and expecting and pricing in these cuts heading into year end. But for us, there's still a lot to do, regardless of what the Fed might do over the course of the next 6 months. The biggest emphasis that we're placing when we're having conversations with investors is what to do with cash. It is a beautiful thing that you can get 4 to 5% risk-free right now, but we don't think those yields are going to last forever. And so step number 1 is extending that duration, locking in those yields for longer, but staying nimble within equity markets and especially taking advantage of pullbacks when they present themselves to start adding risk and position for the next cycle.
Elise, how small do you think that window is? And I understand where you're going with this, and I think a lot of other people do as well. If you're in cash right now, you face some reinvestment risk further down the road. Even if you take a 3-month T-bill, say, in 3 months you've got another decision to make. Maybe you can just keep rolling it forward, knowing that the rates are going to stay up here at 5%. You push back against that idea. At least how small do you think that window is?
It really depends. We expect the Fed to probably start cutting rates by maybe the fourth quarter, but definitely the first half of 2024. And we understand that oftentimes these things take time, and there's not much propensity to put all this money into risk right now. So we would like to start that process, make sure we're jumping on the opportunities that have already presented themselves in terms of mispricing. Europe, again, in terms of equities, is a really great example of that. So it's not like an urgent, back the truck up, dump everything you have in cash right now into risk assets, but we definitely want to focus on starting that process. And it's a big theme of the mid-year outlook we're publishing here in a couple of weeks.
At least embedded in that is just the view that ultimately you think then the Fed is done. And just tying this all together, stocks are going to be okay. The Federal Reserve is going to be done. You should maybe go out and take some duration risk at the same time. You don't think we'll retest the October lows. At least is that the ideal case or the base case? And if it's the latter, what informs that view? What's the number one issue for you?
Base case is that we do not retest those October lows, and also that we do think the Fed is done with this hiking cycle. There is still ongoing stress on the banks, and remember that that is the transmission mechanism of the Fed's policy. So I think the Fed is willing to take a more prudent approach going forward when it comes to policy, and we still have to see how the implications of all of this tightening that's been delivered over the course of the past year and a half kind of play out. But there's a lot of support in terms of offering a floor for the market going forward. And the number one thing I'm pointing to right now is investor positioning. Everyone seems to be bearish. The pain trade definitely is higher. And I think one of the biggest risks for investors is not being positioned for the potential that this market continues to melt up.
Interesting. Elise, wonderful to get your view from JP Morgan Wealth there. Elise Ossenbaugh on the latest, pushing back against some of the gloom out there. Morgan Stanley's Mike Wilson this morning, I went through that quote. I'll go through it again. There are many technical signals that conflict with the idea this is the beginning of a new cyclical bull market. Extreme narrowness, he's talking about breadth there. Quality defensive leadership, broad cyclical underperformance. Then on the other side, you've got the voice for lease there, saying more of the same. Savita over at B of A, Savita Subramaniam talking up the cyclical trade, the equal weighted S&P 500. This is what Savita had to say. If you're just tuning in and missed me reading out that quote, I'll share it with you again. We raise our S&P 500 year-end 2023 price target from 4K to 4,300. We prefer the equal-weighted S&P 500 to the cat-weighted S&P. Double the returns potential, given risks to mega caps. Just a range of views out there at the moment as we continue to grind higher. 13 minutes into the session, up again on the S&P by 0.3% and some, up almost 0.5% on the NASDAQ. Coming up on this program, President Biden expecting U.S.-China relations to improve.
We should have an open hotline. I think you're going to see that begin to thaw very shortly.
And hours after those comments, those relations did anything but thaw. That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Evercore Chairman Emeritus Ralph Schlosstein. That conversation at 10 a.m. Eastern, 3 p.m. in London. This is Bloomberg.
We should have an open hotline. That's what the President Xi and I agreed we were going to do and meet on. And then this silly balloon that was carrying 2 freight cars worth of spine equipment was flying over the United States, and it got shot down, and everything changed. I think you're going to see that begin to thaw very shortly.
The president's remarks come in just hours before China announced that Micron failed to pass its cybersecurity review, ordering key operators to stop purchasing their products with components causing, quote, significant security risk to our critical information infrastructure supply chain. Let's get back to the team. Bloomberg's Anne-Marie in Tokyo, Katie Lyons in Washington, D.C. Katie, what does this mean for Micron?
Well, for Micron specifically, John, it may not actually be that large of a deal financially, because this is a company that is actually less dependent on revenue from China than some of its peers. Only about 11% of its sales come from the country. So analysts seem relatively sanguine about this risk, but note that it could mean additional risk for peers should these semiconductor restrictions spread beyond it to something like Qualcomm or Broadcom, which get a significantly larger chunk of their revenues from China specifically. But this move from China, John, is the first move for a foreign investigation into a foreign firm by their cyberspace watchdog. Again, as you said they found relatively serious cybersecurity risks in Micron chips. They say this is about national security, pushing back against the idea of this being politically motivated. But the U.S. seems to differ, John. The Commerce Department said that Beijing's conclusion had no basis in fact, and that this, along with recent raids and targeting of American firms, is inconsistent with China's assertions that it's opening up its markets and committed to a transparent regulatory framework. And it's worth noting, John, that the U.S. has already taken action in the semi-space against China as well. They blacklisted certain Chinese tech firms, of course, put sweeping restrictions on selling advanced chip-making equipment to China. So there is the sense of this tit-for-tat feeling here.
The timing of this is not lost on anybody. AMH, you were in the room with the president in the news conference over the weekend. You brought up China. Direct quote on the relationship with China and the United States from the president. I think you're going to see that begin to thaw very shortly. MH, what's he referring to?
Well, there's really this two-track policy the administration is trying to conduct with China. On one of that's contact. You've seen a bombardment from this administration trying to set up meetings, really a flurry between Secretary Yellen to Secretary of State Antony Blinken. They're all trying to meet their counterpart. Let's see if that strategy pays off. This week, Jonathan, China's Commerce Minister will be meeting with Gina Raimondo of U.S. Commerce as well as Trade Representative Catherine Tai. At the same time, they are pushing for more, whether it's export controls, sanctions. A lot of talk on the sidelines of the G7 was dominated about the impending outbound investment restrictions. So what China has said in response to all of what Biden said yesterday is, where is the sincerity in this engagement and communication? I asked President Biden directly about, if you want this engagement with China and you want to improve relations, would you consider easing some sanctions? One of those particularly, Jonathan, is sanctions directly on China's defense minister, Li Shangfe. And what you have right now is Secretary Lloyd Austin looking for a meeting with him next month in Singapore. But China says this individual is sanctioned by the U.S. government. Potentially lifting those sanctions would be one barrier out of the way for Austin to sit down with his counterpart. And President Biden told me it is under negotiation. It's under review right now within the administration.
Mate, I've got to squeeze this in. Did Macron's comments come up at all at the G7? His comments directly about China?
His comments likely came up on the sidelines, but not directly in terms of no one was asked in front of a microphone about Emmanuel Macron's comments. What was circulating across the G7, and I know a lot of individuals across these 7 nations saw this article, was what the former prime minister thinks of Emmanuel Macron. What is fair to say, Jonathan, is that that trip and the subsequent interview he did after it and the rhetoric about European strategic autonomy definitely made going into these meetings much tougher. But I think when you talk to officials and they come out and they look at the communique, the fact that everyone's on the same page about de-risking, not decoupling, they think that this was really a win in terms of narrowing that gap between the United States and some European allies.
Interesting. AMH, Kayleigh, to the two of you, thank you. Looking forward to your coverage on the debt ceiling debate throughout the rest of today. Just a timing note for you. This from Jake Sherman over at Punchbowl, reporting that the president will meet with Speaker McCarthy around 4:30 p.m. Eastern time today. That is 4:30 p.m. Eastern time today. There has been, I've noticed a trend over the last week, a willingness to meet and talk around the closing bell and after the closing bout. So it will come after the closing bout. According to the reporting from Punchbowl, President Biden will meet House Speaker Kevin McCarthy around 4:30 p.m. Eastern time. Let's get back to the market action for you. About 23 minutes into the session, just about positive on the S&P with some sector price action. Here's Abby.
Well, John, with that small gain, we do have more sectors higher than not, although some are slipping now. To the downside, we have Staples down 0.6%. This is Target and Walgreens drag. Energy down 0.3%. Chevron down almost 2% on the news that they're buying a shale driller, PDC, in a $6.3 billion stock deal. So interesting. Communication services, the best sector by far, up 1.8% as we have Meta reverse those losses, now up more than 2%. And on the year, John, if we take a look at that sector, up 33%. Take a look at Meta, just ridiculous, up 110% on the year. The stocks also up in a big way, up 26%. And Micron on the year up 31% despite today's loss.
Abby, thanks for that. Your trading diary up next.